Good afternoon, everyone. I'm Tim Richards, Technical Services Manager of the Managing General Agents Association, and on behalf of the MGAA, I'd like to welcome you to our briefing this afternoon. This is being delivered by Matblas on the subject of risk-based pricing within an efficient pricing process. Before I introduce our presenter, I'd just like to run through a few housekeeping points. Firstly, please ensure your microphone and camera are turned off. If you'd like to ask a question, feel free to use the chat button at the bottom of your screen. Time allowing, these will be asked and answered at the end of the event. If we run out of time, questions will be answered post-event. This briefing is accredited for CPD hours if relevant to your ongoing professional development program. The briefing is being recorded and a link to the recording will be issued post-event together with the slides and our feedback survey. Please take the time to complete our survey, which will take no longer than 2 minutes. This allows us to deliver the best possible future events to our members. So as a recap, today's session is on the subject of risk-based pricing within an efficient pricing process from Matblas. So let me introduce you to our presenter, Dr. Anna Matter. Anna is Managing Director and Actuary of Matblas Limited, a pricing consultant with over 25 years of experience working with MGAs, Lloyd's syndicates, insurance and reinsurance companies, designing, collaborating and implementing technical pricing frameworks and processes. Her experience spans over a wide range of insurance products from small commercial lines to complex specialty risks. Anna is the founder of Matblas, an actuarial tech consultancy that pioneered digitalization of pricing models in 2007. Prior to Matblas, Anna held senior actuarial and pricing roles at ACE Europe, currently Chubb, and CNA Re. So without further ado, enjoy the briefing, everyone, and Anna, over to you.
Thank you, Tim, for the introduction. So today in this webinar, we are going to be looking at where MGAs and carriers align, and that is the need for capital. So we'll be looking at pricing, reserving, and risk capital, but we'll be focusing on the pricing side, which is what MGAs do on behalf of the carrier. And within that, we'll be looking at how to incorporate or how to start thinking about incorporating the risk within the pricing models or the pricing assumptions, with the objective to differentiate pricing through the cost of capital. And then we're going to be looking at what an efficient pricing process looks like. There is a lot of talk in the market right now about digitalization, real time, and all sort of use of technology within the pricing arena. We're going to be talking about the 3 pillars of an efficient pricing process, the fundamental components of a consistent pricing framework, and how the data that is generated by this process is really the main asset of the end-to-end process. So the learning objectives today are being able to explain the relationship between pricing, reserving, and capital, being able to outline how to price for the cost of capital at portfolio and policy level, describe what an efficient process looks like and why risk-based pricing is a fundamental part of that process. And at the end of it, I'm hoping that you'll be able to summarize key pricing metrics for portfolio management derived from the pricing process. The first thing I want to make you aware of is that, as you know, capital makes insurance possible, but as MGAs, you don't hold capital. The capital is held by the carrier. It's an interesting report from McKinsey where he concluded that a large part of the insurers are not earning their cost of capital. So essentially, you can still be making a profit, but not covering the required return on capital. And that's what we're going to be focusing today on risk-based pricing. We start by looking at where the various components fit in relation to the risk capital. So we start by raising capital or finding a carrier that will provide the paper and allows to write the insurance product. How much capital is required will determine how we're going to price the policies, what return on the capital we're going to be factoring in the pricing of those policies. So risk capital is at the center of the annual insurance cycle. We start with having the capital, how we're going to price the product, and until we have claims experience, we don't know if the pricing was correct or not. But we still have to provide the carrier and our partners certain metrics. So between pricing and knowing the cost of claims, we are reporting on expected values. We are reporting on expected claims. We're reporting on expected profitability, the return on capital, on expected values, the risk-adjusted rate change, the rate adequacy, and all of that. But all of those reports, which we'll be looking later on between pricing and claims, are on expected basis. The reality might be very different because the actual claims experience will always be better or worse than expected. But it's not until we have claims experience that we are able to look at pricing in retrospect and say, was the pricing accurate? And if it wasn't accurate, what do I have to do to correct it? And then we start the cycle again. Unfortunately, for some classes of business, the lag between pricing and claims experience could be many, many years. So we don't know on an annual basis where we stand with pricing and claims experience. For some of the classes of business like property, the length of time is very short, it could be 12 to 24 months, and we'll know where we stand with claims experience. So we need to be very careful for making sure that we are pricing for the cost of capital, taking into account how long will it take for us to pay the claims from the policies that we're pricing today. I have included reinsurance here, but slightly outside the cycle, pointing to capital. Reinsurance is a form of capital, and carriers will be buying reinsurance as a source of capital to protect the risk they take. Sometimes they buy reinsurance for an entire portfolio where the specific MGA is included, or sometimes they will buy a standalone reinsurance for a specific program with an MGA. But reinsurance is a form of capital, and that has to be included in the pricing assumption. So if we need to cover the cost of reinsurance, the pricing should cater for that. So the MGAs need a carrier, and the carrier needs capital. So this is where the interest should be aligned. On the one hand here, we have the MGAs pricing, underwriting, binding policy. So they have rates that are agreed with the carrier. They'll have a target loss ratio for the specific year of account and on a long-term basis. And they will have discretionary adjustment. But it's the MGA that is pricing the individual policies and making decisions about whether to write them or not. The carrier is looking at claims reserving, so the claims that come from the policies bound by the MGA. So the carrier is going to initially reserve this program at the target loss ratio, and then wait and see when the claims are reported and monitoring actual claims versus expected claims. Capital is available to support the reserve. So for years when the reserves are not enough, the capital is there to support the claims in excess of the reserves held by the carrier. So we have pricing on one hand, and we've got claims reserving on the other hand. The missing link is capital. So risk capital is supporting the reserves, but we need to provide a return on the capital, which has to be included in the pricing. So the MGAs are delegated the task to price for the cost of that capital on behalf of the carrier. And very few MGAs think like a carrier. They don't think about capital. They don't think about reinsurance. They are typically thinking combined ratio. So as long as the combined ratio is under 100%, it's generating a profit, but that profit may not be enough to cover the cost of capital required to support this book of business. So the more MGAs align their pricing and the risk selection with the requirements for capital, the more the interest between the MGAs and carriers will be aligned. So insurance pricing has three purposes. The first purpose, obviously, is to generate a premium that includes all costs associated with the policy, the cost of claims, brokerage, commission, distribution costs, and an internal cost from the carrier. So the first objective is to have a pricing model that generates a premium that covers all costs, including the cost of claims, and the cost of capital, and everything else that needs to be covered by the premium. The second and more important objective is to classify risks according to their risk profile. We don't want to charge everyone the same. So risk classification is essentially aiming at allocating the cost of claims fairly between policies. When we're classifying policies within an insurance pricing framework, we are differentiating frequency of claims, severity of claims based on the risk profile. Because we want fair pricing, we want the high risk policies to pay for the risk, so they need to pay more for their cost of capital, and we want the low risk policies to benefit from the fact that they have a lower risk, a lower requirement for capital. So fair pricing, but more importantly, is to avoid adverse selection. You don't want to price the low risk policies too high because they might not buy from you, and you don't want to price the high risk policies too low because you will attract too many of the high risk policies, creating an imbalance in the portfolio. So fair pricing allows you to avoid adverse selection. And then the third goal of this is to have a process with clear assumptions, a consistent framework. What are your assumptions in terms of loss ratio? What are your assumptions on expenses? What are the assumptions on cost of capital? What return is the pricing going to generate on an annual basis? We need to collect the data so that we can, after the fact, interrogate the data and then analyze a portfolio where we have better pricing, where we're pricing adequately, where the pricing might be coming too high or too low. And then the analytics that we can produce with the data, key pricing indicators, so your price loss ratio, your risk-adjusted rate change, your rate adequacy, the return on capital on a policy-by-policy basis. So the process allows us to capture all that information in a consistent way. So what is risk-based pricing? When you have a business plan, when you have agreed with a carrier, a loss ratio and expenses and commissions for the year, you have that at portfolio level. By the way, this applies to carriers as well, and reinsurance. The principles apply to all organizations that are pricing and selling insurance. In that business plan, at portfolio level, we say what? We have a target loss ratio, let's say, for example, at 55%. We have a commission and expense of 25%. We have the brokerage, could be the retail broker or it could be the binder broker. I have assumed here 5%. The carrier's expense, I've put them here at 5%. And we need 10% for the cost of capital. Okay, so all of these metrics here are a percentage of the final premium, the premium we are looking to calculate. So for every unit of premium at portfolio level, we are going to set aside 55% for reserve, for claims reserves, 25% for the MGA commission and expenses, 5% for the retail broker, 5% for the carrier for their own expenses, and 10% is the profit on the capital that is available to support this business plan. So the most common approach is to apply all of these metrics to every policy in the portfolio. So as long as every policy is to 55% loss ratio, it will generate the 10% cost of capital that the portfolio requires. However, we want to differentiate between policies based on their own risk characteristics. So if I have within the portfolio a segment that is low risk, low volatility, it has a stable frequency, stable severity, no surprises, I can price that to a different cost of capital because it will require lower capital. So I've got an example here of a low risk policy. This policy requires half of the average capital. Starting the other way around, so I said 5% of the premium will be for the carrier. Now half of the average cost of capital will be required for this policy. So for this policy, I only need to account 5% of the premium for the cost of capital because it's a policy with lower risk than average. I have the same expense for the broker, MGA commissions. So the question is, at which target loss ratio can I sell this policy, taking into account that it requires lower capital per unit of premium? So if we work backwards, so we go 25% commission plus 5, that's 30, plus 10, that's 40. So I can sell this policy at 60% target loss ratio and cover all the costs, including the cost of capital. So in a way, compared to the average for the portfolio, I have some room in this policy to deviate from the average premium. So how do we translate that into an adequacy metric, for example? So because I can price this policy at a higher loss ratio or lower margin than the average policy, on a rate adequacy basis, so if I look at technical premium, so agreed premium versus technical, I can afford to write this policy below 100% adequacy at 91.6% because I can factor a lower cost of the capital for this policy. So what this tells me is that sometimes I have to price below 100% adequacy to avoid adverse selection, to avoid losing the low risk policies that are required to have a balanced portfolio. Okay. So at 91.6% adequacy, I am delivering the required cost of capital for this policy. If I have a situation where the policy is actually very, very high risk on the property or on the property side, for example, a policy that is heavily exposed to flood or to nat cat events, and this policy requires 3 times the average capital, I now have to increase the margin for the cost of capital from 10 to 30. Because this policy requires 3 times the average capital. So before I consider any other cost, I need 35% margin for the carrier, 5% for the broker. MGA commission is the same. So what loss ratio will allow me to deliver the 30% margin for the cost of capital that I need for this policy? Again, working backwards, I have 35% for the carrier, 30% for commission and other expenses. That leaves me with 35% to cover the cost of claims on this policy. So I have to price this policy 20 points below the average target loss ratio in order to deliver the cost of capital. So what that means in terms of adequacy, that pricing this policy at 100% adequacy is not enough. It's not covering the cost of claims. I have to price this policy at a minimum of 157% rate adequacy in order to cover the cost of the capital required for this policy. So 100% adequacy on all policies is not always sufficient. So what carriers and MGAs are looking to do is to have hurdle rates to say, for these characteristics, instead of 100, you need 157, or you need 91. So they provide underwriters these metrics to say, don't price this to 100, you need 157 to cover the cost of capital. So it gives information to the underwriters, so the underwriters are equipped to understand, am I covering all my costs and I'm covering the cost of capital. So in very simple terms, the adequacy and the cost of capital have to go hand in hand. So the more capital, the more cost of capital, the lower the loss ratio, the higher the adequacy required for that policy. And ideally, we'll do this at policy level because we don't want to price everything to average. What will happen in this case? The previous policy, if I try to price it to 55% average, might not buy the policy from us because it might be too expensive. Whereas if I try to price this high-risk policy to 55, it might actually be too cheap, so they will be attracted to buy from us. This creates this unbalanced portfolio I was referring to. So what sort of characteristics do we take into account to decide is this a high-risk or low-risk policy within a portfolio? We need to look at potential of frequency of claims. What perils are covered? If it's covering nat cat exposures, for example, that will be higher risk than if it's not covering that. Industry sector, high manufacturing, high risk manufacturing, heavy manufacturing will be more capital intensive than retail for employers' liability exposure, for example. If you're pricing primary and excess policies require a lot more capital per unit of premium than primary policies, because in excess policies, you've got a huge amount of volatility. So if you've got a portfolio where you have primary and excess policies and the average loss ratio is 50%, pricing excess policies at 50% is probably losing money, is probably not covering the cost of capital. Public and private companies will have different risk associated, long versus short-tail classes. You need more margin for long-tail classes than for short-term classes because you need to hold the capital for longer. You also have other risks in the long-tail classes that are not necessarily apparent in the short-tail classes. For example, inflation. You're pricing today, but you're going to be paying for those claims in 5, 6, 10 years' time. By the time you pay those claims, what you charge may not be enough. Okay, so we need to cater for that risk. Loss cost to limit ratio. So if you have low rate on line policies, you will require more capital. You've got more volatility. Legal system, anything to do with liability policies, legal systems also requires more capital. And then how does the policy fit with the portfolio? Is a policy that you're pricing aggregates with other parts of the portfolio, or does it diversify other parts of the portfolio? So if you're writing in a particular geographic location and you're writing more of those, you are increasing the risk because you're aggregating more and more policies in that location. And then one-off versus renewable policies. So if you renew your policies every year, you probably have lower risk than if it's a one-off policy, like a construction policy with 3, 4, 5 year duration. Because you receive the premium at the beginning, but you've got the duration of the policy could be quite long. So all of this is not an exhaustive list, but it gives you a summary of what sort of characteristics to look for when deciding is this a low risk or is this a high risk policy compared to the average in the portfolio. We're going to move on to what an efficient pricing process looks like. Pricing is not about getting the premium and moving on. It is a process, and the data that comes out of the process is the most valuable asset. Everybody is talking around being digital. We want to be a digital organization. We want to be data-driven. We want everything in real time. We want real-time data. We want real-time reporting, and we want to be able to provide all of that data in real time to carriers and reinsurers. What does it mean to be digital? It's effective use of technology, but more than that is essentially having consistent data, single point of data entry, and data consistency across all parts of the organization. A simple example, if you've got multiple products, and in every product you've got a table of countries, they have to all come ideally from a central table of countries. So you spell the countries all the same. You spell the US, the United States, or USA in different tables. Having all of the countries in a single table means that you have now consistency of the data across all parts of the organization. The same thing with the insured name. The insured name can be spelled differently in the pricing system, in the policy admin system, in the claim system. They don't match when you're trying to link data from different systems. So digitalization is about using technology to make the data flow from a single point of data entry to all various parts of the process, creating an efficient end-to-end process, linking to policy admin system, finance, reinsurance, and claims management. So digitalization is around creating operational efficiency. When people talk about being data-driven, it really is important to understand what does that mean. In the context of pricing, data should drive the parameters of the pricing models. When you've got a pricing model that says the average, the premium rate is 1% on revenue or 1% on TIV, where does the 1% come from? Has there been a claims analysis done on prior years to determine that 1% rate is enough to support claims experience? In an ideal situation, the pricing parameters of any pricing model should come from claims data. They should be claims data driven. So when you've got that you are offering a credit for a deductible of 25,000 is worth 80% credit, you have done a claims analysis to show that on average, a 25,000 deductible saves you 80% of claims. That's what it means to be data-driven in the context of pricing, that the data drives the parameters. Other data points that are linked to pricing is the key performance indicators at the time of quoting and at the time of binding a policy. What is produced after you bind a policy? And one segment of the data that is often overlooked is data from quotes that you generate, but that you didn't bind. and granular claims experience. So the more the claims can be linked to the policies, the more we can use the claims experience to be data-driven and calculate those pricing parameters for benchmarking and to drive future pricing and binding decisions. So being data-driven means that we use the data to drive decisions at policy level, at portfolio level, and to understand market statistics. When we're using quote data for policies not bound, we can learn a lot from other markets, particularly if you are able to capture the premium that you quoted versus the premium that it went for. That is an invaluable source of market intelligence. And then eventually we use this to recalibrate pricing models. And what does it mean to be real time? Real time is that all systems have to be talking to each other. Otherwise, we can't have real time. I want to be able to look at claims experience for this policy in real time. There should be a connectivity to the claim system where I look at the policy and it says this policy has not had any claims, or this policy has a loss ratio of 50%, and is connecting the pricing platform with claims platform. On-screen live dashboard. What sort of real-time data we want to be able to pull from various sources? For example, if I'm pricing a particular firm, I'm doing a professional liability pricing, I'm pricing a law firm, I want to know in the last 30 days, what's the average rate I have charged for lawyers, so that I have some information on other similar firms that I'm pricing at this point in time. And that requires live feed from all the policies that I have bound for similar insureds. This real time allows us transparency with your carriers, with business partners, with reinsurers. It allows them to look at your data live. They don't have to wait for a bordereau. They have access to a dashboard and they can see everything that is happening on a daily basis. So investors, internal management, carriers, reinsurers, and producers. So this level of connectivity is what allows us to have digitalization, data-driven, real-time enterprises. But these are the three things that everybody's aiming for. When we talk about an efficient pricing process, there are three key pillars of that process within the pricing, the pricing section of the end-to-end process. The first thing we need is a technical pricing framework. And I'm not talking here about a model. I'm not talking about an Excel file. I'm not talking about a digital platform. I'm talking about the framework. How do we price these policies? How do we start? What are our base rates? What are the loss ratios assumed in that base rate? What exposure base we use? What are the risk drivers that I need to consider to differentiate premium between policies? That could be country, that could be construction type, that could be occupancy. For different classes of business, these risk drivers are going to be different. But what are they? What are the parameters of the model? Where do we give underwriters room to deviate from those assumptions? There could be that a particular company does not fit the assumptions made in the model, because there are always outliers. So where does the underwriter allow for these differentials? Debits and credits, for example. How do we monitor those? How the data comes from the broker. Sometimes we can develop pricing models that are ideal, but the data is not available from the broker. And if the data is not available, we can't use these models. So a technical pricing framework should be designed so that it's consistent. So everyone in that organization arrives at the same pricing up to a certain level, and then there will be the specific underwriting considerations that every underwriter will have some room to deviate from those assumptions based on the specific risk they're looking at that particular point in time. Then we've got the process. So we have the technical pricing framework that allows us to calculate a technical premium policy by policy. Okay. What happens next? What happens when we renew a policy? Do we have to start entering everything else again? How do we link last year's record to this year's record so that we can automate all of the pricing metrics? What was the price loss ratio last year? What was the price loss ratio this year? The adequacy and the rate changes. If we don't have a way to link renewals, all of this becomes a manual process. We have to put all of the data again, and that is not very efficient. So having this consistent pricing framework allows us to build in that link and having all of these automated metrics. And ultimately, that allows us for portfolio segmentation. When we have to deploy capital, when we have a constraint about how much we can write in a particular year, we want to be careful as to where we write. So portfolio segmentation would allow us to look at price adequacy by segment. So we might say, right, so this is not pricing very well, but this is pricing better. So we can grow in this area, but not so much in this area, and then deploy that capital and that capacity wisely within the portfolio. So that's the process. And then where we hold the process is the technology aspect of it, which will allow us automation. So where do we host our rate changes, the rate adequacies? Where do we host management reports? Where we allow the digitalization, single data entry, integration with other systems, and that allows us to go full circle back into recalibrating the technical pricing framework. And I insist that the automation is good as part of being efficient, but you don't want to digitize and automate a bad pricing framework where you don't have consistent assumptions, where you don't have clear assumptions about the metrics, clear assumptions for the cost of capital. Digitizing a model for the sake of having a new platform is not an ideal decision. We start by looking at the framework. Once we have an actuarially sound framework, we can then look at the automation. So when we're talking about a framework for any class of business, these are the standard components of any technical pricing framework for any class of business. We use this for all classes of business that we price, that we assess clients, and it's a standard process. I said we have commoditized the development of technical pricing models by following a framework that allows us to consistently cater for all the components. We've got a exposure base, and then we apply a rate to that. Are there size discounts in the pricing? If there are size discounts, they are pre-built in the process. We don't allow them to be discretionary adjustments at the end. What are the risk drivers? Country, occupancy, construction, depending on the class of business. We will have tables of modifiers for all the various risk drivers. How do we adjust for limits? What if we want to increase a limit? What if we want to reduce a limit? We have that embedded in the pricing. How do we deal with multi-location, multi-currency plans? So you could have a global product. You need to cater for the currency fluctuations in that pricing model or in the pricing framework. Deductibles, are the rates first loss, or do they assume a certain deductibles and then we discount for higher deductibles or lower deductibles? Underwriters, debits and credits, what that means is a risk assessment where underwriters can load or credit for certain risk characteristics like loss history, risk management, health and safety, fire mitigation, mitigation, escape me, fire mitigation measures that they might have in different buildings, and so on. But their debits and credits should be risk-driven. We don't want to offer a discount for risk management if they are just average risk management. If they are average risk management, that's already in the rate. To get a credit for risk management, they have to be much better than average, or if they're not average, if they're worse than average, then there could be a debit. So debits and credits are not to get to a commercial premium, but to get to a technical premium that allows for risk differentials. Minimum premiums, brokerage, if the rates are gross or net of brokerage, we need to adjust. Terms and conditions, what's the wording assumed in the base rate? And what do we include as part of the technical premium? These 11 buckets allows any organization to develop a consistent pricing framework for any product of insurance, because every product of insurance will have these 11 boxes to be considered in the pricing. In terms of premiums, so you could have, this is the specific technology, sorry, a specific terminology we use here at Matblas. You might have your own terminology. But the idea of a consistent pricing framework is that up to a certain point, you put the data that comes from the submission in the model, and you get an automatic a premium, a model premium. Everyone in the organization with the same data will get the same model premium, okay? And that is calibrated to the technical target loss ratio agreed between you and the carrier. Then we've got technical premium. So between model and technical are underwriting considerations based on the risk characteristics of that policy compared to the baseline, okay? So if the baseline assumption is no claims, so someone that has no claims, then it doesn't get a discount. But if the baseline assumption is 50% loss ratio, anyone with lower loss ratio might get a credit. Anyone with higher loss ratio might get a load. This has disappeared now, the presentation. And then that gives you your technical premium. Then between technical and the premium that you bind the policy is essentially market conditions. The technical doesn't have to be the premium that you agreed. That's going to be agreed by you based on market conditions, what you can get at that point in time. Okay, that's the premium agreed for the policy, and it will fluctuate. Some policies you get more than technical, some policies you get less than technical. But the bound premium then drives the pricing metrics. And what are the pricing metrics that every carrier wants to see? Rate adequacy, which is the bound premium divided by the technical premium. The price loss ratio, which is the expected cost of claims for the policy, divided by the bound premium. The risk adjusted rate change, which is the current year's rate adequacy divided by last year's rate adequacy. At the minimum, every MGA should be trying to produce these metrics for themselves internally, but also for carriers. So I'm going to give an example of how this works in terms of calculating the metrics from a technical pricing point of view. So if I have a model that has generates a technical premium of 200,000 for a particular policy, and that has been calibrated to 60% loss ratio, implicitly, the expected cost of claims is 120,000 for that policy. I agree to bind this policy for 240,000, okay, more than technical. The rate adequacy for this policy is 120%. The price loss ratio for this policy is 50%, 120,000 for claims divided by the premium that I'm actually charging for the policy. Okay, so 50%. So I priced it to better loss ratio than planned. It comes for renewal and the technical premium is 300,000. The business plan loss ratio is 60%. And implicitly the cost is 180,000. But I renew the policy for 330,000. Okay. So now the rate adequacy on renewal is 330,000 on a technical premium of 300, that's 110%. The price loss ratio is 180 for claims divided by the premium that I agreed, 54.5. So compared to last year, I have a 50% increase in the cost of claims, but only a 37.5% increase in premium. So we expect this to be a rate reduction. We are worse off because the premium didn't compensate for the increase in the cost of claims. Okay, so the risk-adjusted rate change in the Lloyd's framework is essentially the change in rate adequacy. We've got a rate adequacy for 2023, 110. The rate adequacy for 2022, 120. Adequacy has reduced. So this suggests a rate reduction of 3.3%. So we are slightly worse off than last year because the adequacy has gone down, the loss ratio has gone up. However, it's very important that we're still pricing it above adequacy. So the takeaway from this is not important that you're getting a rate reduction or a rate increase. What matters is the adequacy, because that will tell you whether you can actually afford that reduction or whether that increase is enough. So in this case, we're still above adequacy. So the 8.3 reduction is still okay. We're still delivering the adequacy and the loss ratio that we require. So summarizing, pricing for the cost of capital is where MGAs and carriers align. We need to have clear, consistent assumptions in the technical pricing framework. So a given organization will have their technical pricing framework. It's not every underwriter in that organization has a different technical pricing framework. It's for the organization as a whole. So often this requires training. Changing the mindset of underwriters require training. Start thinking risk-based pricing, not just rate adequacy or not just rate change. Okay, it requires training. How will you use your models and your system to start thinking about risk-based pricing? And pricing, as I said, should be a process of continuous learning and adjusting. So if you've got digitalization and the data flows between systems, you can go and close the circle. So what the claims are telling me, how do I factor in that in the price? And that should be a regular process, a continuous process of adjusting based on data collected. So to recap the learning objective, we have explained the relationship between pricing, reserving, and capital. We have outlined with some high-level examples how to price for the cost of capital at portfolio and policy level. I have described, and hopefully you'll be describing after the presentation, what an efficient pricing process looks like and why risk-based pricing is a fundamental part of that process. And you are able to summarize key pricing metrics, rate adequacy, price loss ratio, risk-adjusted rate change, when you have a consistent and technical pricing framework. That should be a byproduct of the pricing process and not an additional workload for underwriters. It should all come from the same source of assumptions. Any questions?
Thanks for that. I have put a note on the meeting chat a couple of times, actually, if there are any questions that don't appear to be so far. So I'll just allow a few more seconds if anyone's got any. Oh, yeah, just got one in. I'll answer the second one first, actually. Will this presentation be available to us? Yes, it will. Anyone who's registered for this event will be sent the link to the recording together with the slides. So yes, it will. And Anna, question for you. What does TIV mean? I am not familiar with this acronym.
Sorry, that's my fault. This means total insured value, which some companies use to refer to reinstatement cost of an asset.
Great, thank you. And hopefully, Clementina, that answers your question. So yes, it does. She said that's clear. Yeah, and we've just got another comment saying thank you very much. So I think if we'll wrap it up there then, Anna. So thanks very much for your presentation. That was really useful and interesting. I'm sure everyone will agree with that. So you can reach Anna at the contact details shown just at the bottom of that slide there, or feel free to contact me at tim.richards@mgaa.co.uk, and I'll be happy to pass those on to Anna. So thank you all for joining us, and please don't forget to provide your feedback and do look out for forthcoming MGAA events. I hope you all have a productive afternoon. Thanks again for joining us, and see you all soon. And Anna, thanks once again.
Thank you everyone for listening. Thank you.
Thank you.